Good morning, ladies and gentlemen. Welcome back to the Peterson Institute for International Economics. The snow, or the so-called snow, or the shadow snow we get in Washington is not deterred our attendees and has certainly not deterred our speakers, so we are going to get started. It's my great pleasure to have everyone with us for an actually very timely and important set of discussions on the global state of debt and deleveraging. In this effort, we are partnering here at the Peterson Institute with our friends from McKinsey Global Institute under Susan Lund and colleagues, and we'll be distributing copies of their new report on debt and deleveraging later during the program. We also have the benefit of the General Counsel of the IMF, Sean Hagan, with us as part of our ongoing efforts to have the IMF come meet us and greet us and discuss things in an open manner, which they've been very eager to do, and we're grateful for that. Let me, if you will allow me just 1 minute of setup. The term debt has become fraught in recent years in a way that is exceedingly rare to think about. Remember that as everyone invokes Shakespeare, Polonius is neither a borrower nor a lender be. The point of Polonius's speech is that he's an idiot, and if you read the whole speech, Shakespeare is portraying him as someone who contradicts himself 7 times in the course of the soliloquy. And so the idea that we have this great pronouncement against debt is actually something that has only gotten force in recent years. But of course, right now, in the aftermath of the financial crisis, it is something that, even if Shakespeare was not advocating, something many other people are advocating, to rethink our whole consideration of debt, how we treat borrowers, how we deal with overhangs of debt, and has there been progress made? And what we are trying to do today is have a very practical dialogue between the active proposals and thinking on debt restructuring, on deleveraging, with fresh data and assessments of how bad the situation is. And we've chosen, not entirely arbitrarily, to split this into 2 issues, although they're obviously related, dealing with sovereign debt and deleveraging in the first case, and then dealing with debt and deleveraging in the private sector around the world in the second case. Now, if it wasn't for minor things like Greece and Ukraine and Argentina and Venezuela and Puerto Rico and a few others, we might have focused solely on the private debt. But actually, sovereign debt and deleveraging is not something we're going to get away from. And the IMF, to their credit, has tried to advance the debate on how to deal with that. And so today's first panel is to deal with sovereign restructuring, deleveraging, a new regime perhaps, new steps that the official sector can take, the private sector reactions to it, and Adair Turner's specialty, does this entirely miss the point? Speaking first, and as our leadoff presenter will be Sean Hagan, who is, of course, General Counsel and Director of the Legal Department at the IMF. He advises the management, the executive board on all legal aspects. He's been in this job for quite some time. Prior to beginning work at the IMF, he was in private practice in New York and in Tokyo. He's a proud graduate in international political economy from the LSE and a Juris Doctor from Georgetown, and has been out there on this issue, and we're delighted to have him with us. Following him will be Adair Lord Turner, who is combined his careers in public policy and business and academia. I and many of you got to know him when he was chairman of the United Kingdom Financial Services Authority during the crisis. He is now a senior fellow at the Institute for New Economic Thinking. He previously served at Standard Chartered Bank, Merrill Lynch Europe, Confederation of British Industry, and of course grew up as a McKinsey person and now has come full circle in part to join again with McKinsey. And as many of you are aware, he has a book underway on debt. He thinks debt is bad. Third person is our esteemed colleague, Anna Gelpern, who splits her time between here and Georgetown Law, where, of course, she is a professor of law. I'm being too facetious. Anna, we treasure the fact that she has an affiliation with us. She's one of those unique people. Sean may be one of the few others, who's both a lawyer and can speak to economists in a constructive, analytical way. That, of course, makes her great fun at parties. But Anna has written some extremely prescient and practical work over the last year on the Argentina situation, on the Ukraine situation, on notions of pernicious debt and restructuring, and is going to give her unique perspective. And then finally on this panel is our colleague Angel Ubide, who splits his time between as co-director of Global Economics for D.E. Shaw Group, a huge financial investment firm, but also as a senior fellow here. He's been deeply involved in the Euro debate. He was the co-editor with me of our recent briefing on restructuring the Euro. And he is here to give us a bit of market reality check on some of the proposals in the first panel. So thank you for bearing with me. Now all the introductions are out of the way, we can get right into the discussion. This is all on the record, and after our 4 commentators, we will open it up to comments from the floor. Sean, do you want to lead off, please?
Thank you, Adam. So, as Adam has indicated, we at the fund have been engaged in a relatively comprehensive review of our approach to sovereign debt restructuring. And I thought it would be useful to give you a sense of where our thinking is at this stage. Much to your no doubt annoyance or frustration, I am not going to be able to talk about our current engagement in the Ukraine or Greece, nor about the implications of some of these ideas for those countries. I would point out that if these reforms were adopted by the board, which cannot be assumed, at least with respect to the lending framework, it would take at least 6 to 9 months before they were to come into effect. So this discussion has been going on for quite a long time and is not going to be resolved in the next couple of months. When you talk to debt restructuring specialists, even in the corporate context or in the banking context, they'll often divide the system or the issues into 3. First, what is the trigger? When do you start the process? And there's a whole set of issues here about incentives, and the idea is that you want to do it early enough so that you don't destroy value by delay. The second is, once the process is started, what is the framework for the negotiation? What is the process? Both between the debtor and the creditors, and also among creditors, because often this is complicated because it's an inter-creditor debate. And the final stage is the design of what I refer to as the closing mechanism. What is the framework that you have in place that makes an agreement that's been reached by the debtor and a majority of its creditors binding on all the creditors? And we are looking at all 3 phases of this in the sovereign context. They're different in the sovereign context, but at a certain level of abstraction, I think it's a useful taxonomy for looking at the issues. And I think it's fair to say that we've made the most progress on the last stage, which is the design of the closing mechanism, which is how do you address collective action problems by basically enhancing the legal framework to bind minority creditors. Now, that might sound odd starting from the back, but actually what's important to realize is that having a good framework at that stage has positive feedback effects for the rest. It defines the leverage in negotiations. But most importantly, removing uncertainty on collective action problems enables the process of restructuring to initiate at an earlier stage because there's less uncertainty as to whether or not you're going to be able to close. So what I'd like to do is to start off by talking a little bit about the progress that we've made on this closing mechanism, and then talk about where we're sort of in the middle of the process, which is on the trigger. And point out at the end that on process, we haven't started that discussion, although I know that a number of people in the audience are very interested in the fund's lending into arrears policy, which really is a critical component in the middle phase of the restructuring discussions. So, on the closing mechanism, I think the issue here is relatively straightforward in theory. We're talking about collective action problems. It's a form of market failure. It's not unique to the sovereign context. Many corporate insolvency laws are designed to address these issues that enable a majority of creditors to make an agreement binding on a minority. I think it's fair to say that historically, collective action problems have been less significant in the sovereign context, partly because of the rather sui generis legal nature of claims on the sovereign. Even though over the last 30 years it's become much easier to get a judgment against a sovereign, many countries have modified their sovereign immunities laws to allow for that. It's much more difficult to actually satisfy that judgment by finding assets. And that has been a source of considerable frustration for judgment creditors. The other thing I would say is historically, as an institutional matter, creditors have essentially wanted to preserve long-term interests with their sovereigns and therefore have not resorted to sort of aggressive litigation tactics. This was the case, for example, during the 1980s. Well, I think for both institutional legal reasons, that state of the world has evolved. Partly because of disintermediation, many claims now are held by bondholders who don't necessarily have long-term interest relationships with the sovereign and are willing to basically maximize the value of their claims. If that means litigation, that's also an option that's on the table. But more importantly, I think there have been significant legal developments, which Anna has followed very closely in the case of Argentina. But this is a development that really started back in Peru, which is creditors have come up with a strategy where they don't necessarily need to find assets. What they can do is get a court to interrupt payments to the creditors who had agreed to go into the restructuring and interrupt payments on that restructured debt. And of course, this is the celebrated feature of the Second Circuit's decision on Argentina, the NML case, with the interpretation of the pari passu clause. And of course, from a collective action perspective, it raises at least two issues. One is now you actually have a holdout strategy that's viable, so it may increase the number of holdouts. But secondly, if you are inclined to accept the deal, you may be less inclined to do so because payments to you could actually be interrupted. So it creates a degree of uncertainty. Now, how much uncertainty? Well, one of the really interesting discussions that's going on in the legal community is how broad of a precedent is the NML case in Argentina. If you read the case carefully, it's based on a course of conduct, and the question is, what course of conduct are they talking about? Is it the lock law adopted by Argentina? Is it the persistence in the default? There's a lot of discussion on this issue. We issued a paper recently where we try to walk through what the different considerations are. But suffice to say that there is enough concern that many creditors have themselves basically engaged in a process of modifying bond documentation so as to basically reduce the risk that this disruptive litigation could create in other cases. And basically, there's been a process underway for almost 2 years now with the International Capital Markets Association, the U.S. Treasury, who I want to acknowledge if anybody's here, who basically played a key role, and IMF staff. We've had a very extensive discussion about modifying collective action clauses to address this problem. Collective action clauses are clauses in contracts that mimic bankruptcy because they allow for a majority of creditors to bind a minority. The traditional problem is that they do so within the four corners of that bond issuance. So it's relatively easy for a creditor to get a controlling position in the bond issuance and neutralize these clauses, which in fact happened in the context of the Greece restructuring, which can create its own adverse dynamic. So the big initiative has been, or one of them has been, to basically try to come up with a collective action clause which aggregates claims across instruments. So essentially, it neutralizes or sufficiently dilutes the capacity of a creditor to disrupt the process. And what's interesting is that we've been able to actually reach closure on key features of clauses that would embrace this feature. And what's also quite extraordinary is that these clauses have already found themselves into bonds governed by both New York law, Mexico came forward, and also by English law with Kazakhstan. So I think there's been tremendous progress in this area. I think the fact that creditors viewed it as a priority is significant. I think it reflects the fact that ultimately there's no shift of legal leverage from the creditors to the debtor, but rather from individual creditors to creditors as a group. And that's one of the reasons why it was acceptable. It's at one level an incremental change because it only applies to new debts, and we have an outstanding stock of about $900 billion, a significant portion of which only matures after 10 years. So it doesn't address the outstanding stock. Only a statutory approach could do that. And the fund has made it very clear that in this area, the reforms that we're proposing are on the basis of contract as a market-based approach. So on this first issue, this closing mechanism, I would say, significant progress, not a silver bullet, but as far as we're concerned, I think that essentially we've made more progress than we had originally thought we would do in a shorter amount of time, particularly because they've been taken up by the market without any adverse pricing. Second issue is on the trigger, when to initiate. And in contrast to the legal framework where the fund is trying to facilitate an agreement between debtors and creditors on how to contract, this actually involves effectively the fund looking at its own lending policy and over which we have control. That doesn't make it any easier, though, in terms of trying to implement reform. And, we're at a much earlier stage of discussions, and the views expressed by the board on the initial paper have been wide-ranging. So let me just sort of give the context. Why is lending policy the effective trigger? Well, when a country enters into debt distress and loses market access, it inevitably comes to the fund for financing. And whether or not a fund-supported program triggers a restructuring will depend on whether or not the IMF will condition its access on a restructuring or whether or not it will provide financing without it. Often, therefore, the fund's decision on the conditions for its access effectively become the catalyst for the initiation. And some history on this, the fund had been addressing this issue for a number of years since the Mexican crisis, where there were requests for large amounts of financing, and relied on what we called its exceptional circumstances clause, which allowed us to provide large amounts of financing, which is normally what happens in capital account cases, where we basically believed that, on balance, it was the least cost approach, both for the country and for the system. I think it's fair to say that after what happened in Argentina in 2001, the fund decided to have a more disciplined approach. There was a concern that the disbursement that we made, in particular in the fall of 2001, delayed a restructuring that essentially many believe had become inevitable. That at that stage, effectively, Argentina's debt was unsustainable, and that providing financing without a restructuring in that context was not good for the country, not good for the fund, and not good for the system. So there was a large debate about how to impose this discipline. And without stylizing it too much, I think there were two options put on the table. One is what I call the hard automatic approach, which was just essentially have firm access limits. And when a country came to the fund, if its request exceeded access, the fund would not provide financing, which essentially would require the financing to come from a restructuring. The other approach, which was ultimately adopted, was an approach which had a form of what we can call constrained discretion. And the idea was to preserve the flexibility to provide financing, indeed large amounts of financing, in circumstances where, notwithstanding the debt distress, the loss of market access, there was a view that fundamentally the debt was sustainable, and that the problems were caused either by exogenous shocks, by perhaps a policy mistake, but the fund had confidence that essentially the situation, with the fund support and a strong adjustment program, would turn the process around. So the idea was that we would have lending based on a criterion of sustainability. So the rule was the debt had to be sustainable. But the judgment was that sustainability is not a science, it's an art. So there was a recognition that there would need to be a considerable amount of judgment in the application of this criterion. And over the years, the fund has tried to refine its analysis through debt sustainability frameworks. 2010 comes along, and we have Greece, and it's fair to say that fund staff did not have confidence that this criterion on sustainability could be satisfied. There was no high probability that the debt was sustainable, which is what the standard that's required. So in that context, the framework was amended to introduce a new rule that in some respects is orthogonal to the sustainability axis, which is that notwithstanding concerns on sustainability, we can provide financing in the absence of any debt restructuring where there's a concern about spillovers. And of course, there was a significant concern about spillovers in the Eurozone in 2010, as you know. So that's the framework, that's the access framework that we are in the process of reviewing. And our thinking on possible changes to that framework are outlined in a paper that was issued in June of last year. And I think it's fair to say that there is no suggestion that we move away from the principle of constrained discretion. The idea of, and that the underlying criterion should be that of sustainability. We're not suggesting absolute caps or anything like that. What we are proposing are two changes. One is to eliminate the systemic exemption that was introduced in 2010. And this is based on several considerations. First, there is the issue of consistency with our mandate, which is the fund's primary obligation is to help countries resolve balance of payments problems. To the extent to which it's exacerbating those problems by continuing to delay our restructuring and providing more financing, which has to be repaid on non-concessional terms to the fund, it's not actually helping the country, it's actually exacerbating the balance of payments problem. And although clearly systemic considerations are always a concern for the fund, I think there's a concern that it cannot compromise this underlying obligation of helping individual countries for the system. The second is that, at least as designed, it's not clear to the staff that the systemic exemption actually achieves its objectives of addressing contagion. We are preparing a paper that will look at this issue, will look at the underlying causes of spillovers, the channels of spillovers, how the adverse consequences can be contained. And you'll be happy to know that this is a work that's not being led by lawyers, but by economists. My colleague Hugh Bradenkamp is here, who can elaborate on some of the analysis, the review of literature on this issue. But in essence, the conclusion is that if there are spillovers, they arrive from debt distress, whether or not a debt restructuring occurs. And the spillovers will only abate, the adverse spillovers, if that underlying cause of debt distress is resolved. And if, in fact, a program for the fund does not resolve that issue, because there are underlying concerns regarding sustainability, it's not clear that basically such a program will actually address contagion. As we have discussed with a number of creditors, there has been an historical concern that while in these cases some creditors end up getting paid out and leaving, other creditors with longer term maturities don't. And there ends up being also a form of structural subordination, because the new debt that comes in, the official debt, is essentially senior. So when that restructuring eventually comes, which often it will, the full burden of the debt relief falls on those rather narrow shoulders. Now, I think you will see that the paper that we're writing will point out that we accept the fact that there may be circumstances where the official sector understandably wants to avoid any form of debt operation because of systemic consequences. What we're saying that in those circumstances, the best way to do it is for the fund to provide funds financing in conjunction with concessional financing by those members that are most affected by the contagion, but the concessionality is designed to address the underlying sustainability concern. Now, this doesn't mean that we need to have a new concessional financing facility. What we're looking for is a political signal from countries that they are willing to take measures that will address the underlying concern on sustainability, because we believe that that's the only way to resolve the uncertainty. My final point on the other proposal, the second aspect is we want to create a little bit more flexibility to the framework that was established in 2002. I mentioned that the requirement is that debt must be sustainable with high probability. Now, we think that this makes a lot of sense, and that when you have a country that clearly has unsustainable debt, you need to have a debt operation that delivers that outcome. We're interested in outcomes, not in specific operations. We want to have a debt restructuring that delivers that outcome. But where you're not sure, and there are circumstances where there is uncertainty, because this is not like the corporate context, the line between illiquidity and insolvency is not straightforward. Where you're uncertain, requiring an operation that actually is definitive, that gets you to an outcome of high probability, may not be the least cost approach. What we would like to be able to do is, in those circumstances, to have the flexibility to support operations that, although don't change the debt dynamics in any fundamental way, essentially provide insurance by having a short extension of maturities with a limited NPV impact, because there would be generally no reduction in coupon or principal, so that if in fact the country was able to make it to sustainability through adjustment, fine. But if it couldn't, at least there would be a broader creditor group, a more flexible creditor group that would be able to absorb the restructuring. And we actually also think, and this is my final point, that on balance, this would actually, relative to a program that just bails creditors out, this could actually improve sustainability because it provides additional financing to support a less constrained adjustment path, and also because the creditor group is private. It might actually accelerate return to market access because of the concern regarding structural subordination. So, bottom line, no fundamental changes. Actually, we're trying to go back in some respects to what we were doing before the systemic exemption. We survived for many years without it, and we think it might be better to go back to it. And secondly, we're trying to introduce some degree of flexibility. So I'm sorry I've abused my time. Thank you.
You abused it with beautiful substance, so I will let you get away with it. Thank you very much, Sean, for setting things out so clearly, so forthrightly, and giving us a good understanding of both the intent and the proposal. Adair, we turn to you. You've done work with MGI, McKinsey Global Institute, on the broader issue of public sovereign debt. how do you see the issue in broad, and where does this fit in?
Good. Adam, thank you very much. It's a great pleasure to be back here at Peterson Institute. I mean, Sean has talked about the structures for the future, both as to the nature of the conditionality of lending and also the way that we deal with problems in the future by better contractual design. But in the middle of it, you mentioned, en passant, I noticed a reference to outstanding stock, which is there already. And it's the outstanding stock that I want to talk to and say some points about this document, the McKinsey Global Institute document on debt and not much deleveraging. And the fundamental thing I'm going to say on sovereign debt, though I think it also applies to private debt, is that the accumulation of stock which we have in the world at the moment includes significant amounts which are unsustainable and will not be repaid in the normal sense of the word repay. The basic fact is that over the last 7 years, in the advanced economies, the total level of public debt has gone up on average from 69% of GDP to 104% of GDP. And of course, one might think, well, what a lot of profligate governments that is who've been out there borrowing money. But the crucial thing to understand about where this came from is that across most of the world, it has derived as a knock-on effect of a prior expansion of private credit. Private credit in the advanced economies grew grew continually over 60 years, from 50% of GDP in 1950 to 170% by 2007. That, along with some features within the financial system, then produced a crisis. And after that crisis, we entered a period of attempted private sector deleveraging, which depressed nominal demand, depressed economies, and made it inevitable and sensible that governments should run large fiscal deficits to offset that deleveraging depression, but with the inevitable consequence, which is the absolute core message of this report, that the debt hasn't gone away. It has simply shifted from the private to the public sector. And indeed, if you look across the world, and this was also set out 3 months ago by what was called the Geneva Report, who also did this analysis, we find that there has been a limited amount of private sector deleveraging, but for every percentage point fall in private sector debt, there has been a bigger increase in public debt. And total debt, private and public combined, has simply gone up. And as I say, I think you therefore have to understand the increase in public debt, in particular in countries like Spain and Ireland, less so perhaps in Italy and Greece, as fundamentally deriving from the private sector credit boom which lay before. Now, I believe that the amount of public debt which now exists in several countries is at the level which will not be simply worked out in the classic sense of repaying debt. And that also was the conclusion in the paper by Carmen Reinhardt and Ken Rogoff in November last year, based upon a historical analysis of debt repayments, based upon expectations of what are likely real output growth rates and inflation growth rates, and therefore the feasible level of the growth of the denominator, nominal GDP. If you put all that together, I simply is not credible that a large amount of the debt which is out there is actually going to be repaid. Let me illustrate that with two examples. First, Japan. Now, Japan should have been the canary in the mine of the problems we were going to face after 2007, because they faced them from 1990 onwards. They had the private sector credit boom back in the 1990s, they had the balance sheet recession thereafter, and they now have gross public debts of 230% of GDP. There is in the document that the IMF produces each year, the Fiscal Monitor, a nice piece of analysis which illustrates what is required in order to pay down that debt. And the scenario shows what Japan would have to do in order to reduce not gross debt, but net debt of 140% to 80% by 2030. And the figures in the latest Fiscal Monitor say that in order to do that, they will have to switch over the next 5 years from a cyclically adjusted primary balance of -6% to a positive of +6%, and maintain that ever thereafter. Now, I will not bet many things in life, but I will bet you that that is not going to occur. I will bet you that if attempted, it would tank the Japanese economy into a far deeper recession where the denominator would fall and we'd get no deleveraging at all. But that is not just the situation in Japan. The IMF Fiscal Monitor, and there are also variants of this analysis in the McKinsey report, also show the level of the primary surpluses which Spain and Portugal and Italy and Ireland and Greece would have to run. And as Barry Eichengreen pointed out in a recent article, think about these being permanently at about 4% for Ireland, about 5 or 6 or even 7% for Spain and Italy and Portugal, and 7% or more for Greece. Now, you may say, well, that's just a scenario. We don't really believe it. But actually, in the European Union, the Eurozone debt brake, that scenario has been turned into a legal requirement to bring down the debt to supposedly sustainable levels. So I'm saying that debt burden will not be reduced by the classic process of turning a primary deficit into a primary surplus big enough to pay down the debt. So what is going to happen? I think we have to draw a distinction between those countries which are their own currency issuing power and which have issued the debt in their own currency, and therefore where public debt sustainability is ultimately underpinned in nominal terms by the fact that the central bank can, if it wants, monetize the debt, and those which are in a different position. Now, the different position, of course, includes developing countries which have issued debt not in their own currency, the classic problem of debt sustainability from the literature of the 1970s and 80s. But I'm not going to talk about that. I'm going to talk about Japan and the Eurozone. What will happen in Japan? Japan is going to permanently monetize its debt. At the moment, Japan has about $1 trillion of debt outstanding, of which the Bank of Japan owns 200 billion. The Bank of Japan is buying the debt at 80 trillion a year. The government of Japan is issuing it at about 40 trillion a year. The amount of debt which is not held by the Bank of Japan is declining. By 2017, at the current pace, the Bank of Japan will hold almost 100% of Japanese GDP in debt, in government debt, and I will assert that it will hold it permanently. That the government of Japan did not do what Ben Bernanke told it to do in 2003, do a helicopter money drop, but it is essentially taking a post facto operation which turns those previously funded deficits into a helicopter money drop. The problem in Europe is you can't do that because the European issuers of sovereign debt are not really sovereigns at all. Charles Goodhart, Professor Charles Goodhart of the LSE, has a wonderful phrase about European sovereign debt. He says this is sub-sovereign debt. You have to think about the debt of Spain and Italy and Ireland as being the equivalent of the debt of State of California, of State of Illinois. It is debt issued by people who don't issue their own currency and don't have a central bank which can ultimately buy it. So what will occur? Well, it is not all going to be repaid because there will be either of two things which mean that people can walk away from the debt. There will either be a set of political reactions where this debt becomes simply unsustainable, politically unsustainable, and this is the point that Barry Eichengreen made in his article, that it is not believable that these countries are going to have the political will to sustain these primary surpluses over multiple years. And we are a long way away from putting behind us the radical populist political movements in Europe which want to reject some of this debt. Or let us remember that individuals can always work away from sovereign debt, particularly if they are members of a European Union which has free movement of people. It is not a rational point of view, it is not a rational action for a young Greek person to stay in Greece, accepting the burden of taxation required to repay these past debts, and they don't have to stay there. They can move to Germany and pay only the taxes required to repay German debts. So my conclusion is we have a level of debt within the European environment, where we have a level of debt and sovereign debt across the world, which will not be repaid in the normal sense of the word repay. In some countries, and in particular Japan, it will be permanently monetized. In some, and in particular the peripheral countries of Europe, I think we have not got to the end of the issues of debt restructuring.
Thank you very much, Adair. I will resist the urge to make any comments on Japan. I will just say a couple things. The report, hold up the report, please, Adair. Copies of this will be available, are outside, and available for download from the event, along with the event on the event page on our website. You can put it down now, along with a smattering of our writings on this issue. I would just point out, apropos of Adair's comments on Europe, last year we published William Klein's book on a different form of doing assessments of scenarios in Europe and European debt, with a methodology of looking at co-movements in growth rates and risk with debt scenarios. He comes out mildly more optimistic than Adair does, and I would urge you all to look at Bill's work on our website. And also a recent policy brief by our newest senior fellow, Paolo Moro, who talks about the fragility of the ability of governments to pay off their debt going forward as growth rates get downgraded, both of which I think are useful complements to what Adair was saying. Let me now turn to the aforementioned Admirable Anna Gelpern to bring us back to some of the issues Sean raised, and she is in a position where she can speak, as she has written, about Argentina, Ukraine, and the applicability of these things, and I hope she will.
Thank you very much, Adam. It's a privilege to be here. It's a privilege to comment on the fund's recent initiatives. And I want to just open by saying I am a big supporter of what you're doing. And by saying that up front, I hope to give myself a little leeway to be a constructive supporter. I want to open with some background, which is that we have to just stand back in awe at the unprecedented breakthroughs and reforms we have seen just over the last few years in sovereign debt. We have had record-breaking bond restructurings that have gone relatively smoothly. We have had unprecedented contract reforms, which Sean has already mentioned. Now, to see how important this is, you have to think about the fact that the League of Nations in the 1930s started advocating some of these reforms, and for decades nothing happened. The G7, the Treasury, the Fund worked on this in the mid-90s, early 2000s. What has happened over the past year is truly astounding, and I think the Fund and the market participants and the Treasury are certainly deserve massive credit for that. We have also seen judicial decisions that for the first time in modern memory raise the prospect that sovereign debt could be enforced in a replicable, generalizable way, right? So you can only find so many tall ships to seize and fewer to sell, but payment flows are everywhere. And the contract clauses that got Argentina into trouble are also everywhere. Finally, we've even had a treaty framework in Europe that specifically addresses debt restructuring. So this is really just an incredible wave of reforms. And yet, Greece is on the edge of another, call it what you will, within just a couple of years of the biggest and arguably most successful bond restructuring in history. After the unprecedented court victories for creditors, Argentina's defaulted debt was not paid in the conventional or any other sense of the word, but has tripled. No one is getting paid. Meanwhile, Grenada, Ecuador were fighting lawsuits from creditors. Ukraine has hired advisors just within months of having its debt declared sustainable with high probability, asterisk subject to geopolitical contingencies. Meanwhile, the UN is negotiating a framework for sovereign debt restructuring. So this is a time of turmoil. And all this to say that the IMF's policy review comes at a critical time, and what the fund does is going to be very important, no matter which way it all comes out. For better or worse, the IMF is the glue that holds together a fragmented, convoluted debt restructuring process. Sean has alluded to this, and I'll revisit. The debt sustainability assessment effectively sets the parameters of restructuring, or not a restructuring. The program sets the reform conditions. The lending policy, really the exceptional access policy, creates the incentives for debtors and creditors to come together and the scope for compromise. Now, the fund wears multiple hats. It's an advisor, it's an analyst, it's a creditor, it's a membership institution, and of course, it's a guardian of systemic stability. Therefore, it is essential for fund policies to be credible and to be seen by the markets and by the people for whose sake it is all being done as credible. Now, credibility comes from process, and credibility comes from outcome. The process must be intelligible and predictable, and the outcome must be sustainable. From the standpoint of both process and outcome, in my view, it is simply not credible for a membership organization on the front line of international financial crisis response to operate in a thicket of detailed rules and arcane terminologies that are accreting like, barnacles on an old boat. More rules doesn't mean better rules. These rules will be broken and engender further distrust. This cannot turn into a vocabulary contest where new terms are being debated every quarter. Whether, again, we are talking about repayment and reprofiling in the normal sense of the word or any other. Therefore, I am delighted and I really welcome the return to flexibility in the IMF's crisis response that the recent proposal for lending framework reform represents. If a government comes to the fund for extraordinary support, the IMF should be able to ask other creditors, public and private, to share in the burden of resolving this crisis in an equitable way, period. I also welcome, and I think it is wonderful, that the systemic exemption is on its way out. I think it is an embarrassment. Now, I want to flag that this is quite apart from whether it should have been used in Greece. Right? Whether something is done in an emergency is in some sense a separate judgment. But lending to a country that is already in over its head for the sake of bigger countries next door should not be sanctioned as part of regular policy. If it happens, and it still might, whether the exception is there or not, it should be a visible departure from the rules, and it should be a wake-up call for the system. And in some ways, I'm very glad that what happened here turned out to be such a wake-up call. So again, I'm delighted that the systemic exemption is on its way out, but I do think that in order for that to be credible, you need a backup plan to address contagion, and I'm delighted at the work stream that Sean described. On the other hand, I am befuddled, I continue to be befuddled and a tad distressed by the introduction of new categories and vocabulary words, like reprofiling, rather, as distinct from restructuring. New triggers, such as sustainable but not with high probability, maybe or maybe not subject to geopolitical contingencies, and, sunset on the East Coast. The cagey language, the use of words like normally and generally that you will see cropping up in these policies, I think betrays the discomfort of the proponents of new vocabulary words and new soft constraints. I think this is a recipe for obfuscation with more opportunities for manipulation and distrust. What is a category of sustainable but not with high probability? You've got two variables here, sustainability and probability, go figure. How would normally, without any reduction of principal and interest, be implemented? Perhaps more importantly, how would it be understood? How would it be priced, predicted? To be clear, I do not doubt that maturity extension without principal reduction can be a good idea. A much better idea, perhaps, than principal reduction in any given case or in most cases. I don't even quarrel with the preference for maturity extension in many cases. What I dislike is the appearance of detailed pre-commitment. I think that any such, anybody who thinks this is a pre-commitment and a predictable path forward would probably be disappointed. Now, what should be done? I am a big fan of simple rules that are visibly broken. So I actually think that it should be clear by now that any request for exceptional assistance from the public sector might or might not occasion an exceptional request to change the terms of the debt, right? And anyone who says this is all about sovereigns, I think, is mistaken. Just look at GM bankruptcy, right? When the government comes in, rules, whether they're in statutes or in decades of practice, funny things happen to rules in that circumstance, right? Therefore, I think it would be much better for the fund to stick with the policy of case by case, but to provide a detailed contemporaneous justification and ex post assessment of the burden sharing strategy, something that it's already on the way to doing with reforms to DSA and others. Constituents in the market and, very importantly, in the street can make up their own minds about whether this is right, and what it means for them. I think anything else is probably a mirage that would do more harm than good. So with that, again, I am grateful to be here. I just want to reiterate that I'm a big, big supporter of this new path, and congratulations.
No, thank you very much, Anna. Turning now to Angel Ubide, there are two things I neglected to say when introducing him before. First, he is a veteran of the fund, having been there during the Asian crisis and worked on, I believe, the Korea program, and so comes to this not as a pure market person. But secondly, that we are very fortunate, just as Anna helps us bridge the gap between economics and law, Angel has helped us bridge the gap between market behavior and macroeconomics, which is always a bridge too far, but he tries. We're grateful to have Angel getting more involved with us as time goes on, and I turn to you for your views.
Thank you. And let me just say that Anna just said that the Greek debt restructuring has been the most successful debt restructuring in history. And I think after learning that, I don't know if we want to continue to discuss changes to the framework for debt restructuring at the fund, but anyway. Let me start by saying that it took me 3 reads to understand what the paper says, even though I did work at the fund and I did provide comments on the first version. So let me try to give you the summary of what I think the paper is doing, right? The paper tries to say 2 things. The new policy implies that countries will be allocated in 3 buckets if they ever call the fund and they need exceptional access. Sustainable with high probability, you get a program. Sustainable without high probability, you go to reprofile. Not sustainable, you have to restructure. Let me note that in 2 of these 3 events, there would be a CDS event. And this is something that I think needs to be remembered. The second point is that the systemic exception would be eliminated, although the paper essentially agrees that what was done in the euro area would be a viable option. In other words, if you want a systemic exception, you come and pay for it, and then the fund would contribute, basically following the rules that it has. Now, my main worry, and just to give an example here, is that everything hinges on the definition of sustainability with high probability. And nobody knows what that means. It's not explained in the paper. I would respectfully disagree with almost everything Adair Turner said about the sustainability of debt in the world today. And if that gives you 2 views on what is sustainable, then I think there are going to be many views on what is sustainable out there. It's a bit like a central bank announcing that it's going to adopt a price stability target, but doesn't define what price stability is or provide a numerical value for the target. It's very difficult to follow. And when you want to put that into a policy, I think it can create more problems than it solves. Now, the paper has 2 interesting contradictions. The paper said that the new lending policy would accept reprofiling as a condition for exceptional access, even if it doesn't restore sustainability with high probability. At the same time, it says it would accept concessional assistance as a condition for exceptional access because it would restore sustainability. So it would be willing to provide exceptional access with or without the debt being sustainable with high probability. The same applies to bucket number 1. I will give you exceptional access if your debt is sustainable with high probability. Or bucket number 2, I will give you exceptional access if you reprofile, even if your debt is not sustainable with high probability. So what is the conclusion from this? I think what this means is that the ultimate objective here is essentially to increase the probability of private sector involvement and reduce the expected use of fund resources. And I continue to disagree with this fundamental point. I think at the end of the day, the fund lending policy should be to maximize its effectiveness during a crisis and should not be based on the amount of balance sheet that is deployed. Now, this new policy would want to eliminate the systemic exception. Let me just walk you through the 3 arguments that it uses in the paper. The first one is moral hazard. And I continue to think that you deal with moral hazard ex ante, via more information on sustainability, naming and shaming, and other things, rather than ex post. It claims that it's too narrow, that it would only apply to a few countries. Well, that's just the way it is. Not everybody can be sustainable. Now, make those systemic countries pay ex ante for this insurance, have heightened surveillance, have more data disclosure. It's a bit like demanding extra capital to a SIFI, if you think about bank regulation. And then it says that it's too broad. Well, that's precisely the point. You want to address the unknown unknowns. That is why the Federal Reserve had 13.3, and that's what I think the IMF should have, the systemic exception. You don't know what's going to happen one day. It is, at the end of the day, impossible to define ex ante what is systemic. I don't think anybody thought Greece would be systemic. I don't think anybody thought Ukraine could be systemic. I have no idea what's going to be systemic in 5 years. And so you could define the systemic exception as an option with positive expected value. And I don't see why we should get rid of it. Or at least I need the stronger arguments to be convinced that we need to get rid of it. Now, one of the things the paper does is to say at the beginning that the presumption of reprofiling is not there. Now, it is not there on paper, but I have to say that given the high levels of debt in many countries, given what Adair Turner just told us, that in many countries the debt is going to be unsustainable, and given that the quotas have not really increased in the last several years, I would bet that there is a de facto presumption that whoever calls the fund, especially if it's a big country, is going to be subject to reprofiling or restructuring. And so if you continue with this logic, then the probability of calling the IMF and then CDS triggering increases under this kind of policy. And this is something that is going to create potential domino effects. So it is, I commend the fund for insisting that there is no presumption de jure, but I think de facto the presumption remains. Why do I think this? Because we need to be convinced, and let me put my market hat on the power of anchoring in financial markets, right? Why did we have the problem we had the last 5 years in the euro area? Because of the anchor of PSI. The moment the process of PSI started, everybody started to price Spain and Italy under the probability of a restructuring. Now we have the same problem with the anchor of Grexit, which is a word I don't like, but I'm using because everybody understands. Why are we saying that the only option to Greece agreeing to a program is to leave the euro? Well, because it has become an anchor, and that anchor is now pricing all Greek assets. This would be a similar thing in terms of creating the anchor of reprofiling. Now, you would tell me that the markets would only price restructuring or reprofiling if there is a fundamental reason to it. Well, think about a different one. Why do you think that the day the Swiss National Bank decided to drop the Euro-Swiss floor, everybody started to bet that the Danish National Bank would have to leave the Euro-Danish Corona floor? It's called anchoring. There was nothing fundamental about it. It's not that all of a sudden people woke up on a day and said, oh, the Danish currency is overvalued or undervalued or anything else. It's the power of anchoring. That's the way markets work. So the paper tries to evaluate the beauty of reprofiling based on the speed of return to markets. I think that's incomplete. It should evaluate based on the impact that reprofiling could have on growth on the country that requests assistance, and then think about the impact of the tightening of financial conditions. Now, if I take that argument a little bit further, sustainability is basically an endogenous concept, right? It's endogenous to the policies that the country is willing to adopt, essentially the willingness to pay. And so we need to think about type 2 errors. Imagine this policy had been in place in 2010. My bet is that Portugal and Ireland would have been found sustainable with low probability. And that would have triggered an automatic reprofiling or the automatic pricing of reprofiling in several of these countries. Now, do we think they are sustainable today? I have no idea. I guess we can agree to disagree on that. But we need to think about these issues. How many type 2 errors could have been made in the past if this policy had been put in place? And I think we need to consider one thing. I know the report says, the McKinsey report says there is too much debt. Let me offer an alternative view. When markets are pricing negative interest rates, I think markets are saying there isn't enough debt. There is an excess demand for debt instruments that guarantee the repayment of a principal. Now, if you were to at least take this view half seriously, you would think that you don't want to mess with the integrity of assets that promise the repayment of the principal. And then you can think about different ways of solving these problems. So let me make a couple of suggestions. The first one, and that's where I take Anna's line, if it's not broken, don't fix it. I think the option of reprofiling is always there. The case for too little, too late restructuring is very weak. And I would frankly want to have a systemic exception in however legal form. If the current one is not the right one, then let's find a different one. Because the objective should be to minimize the GDP cost of a crisis, not the use of the balance sheet of the fund. Now, I wouldn't want policies to be made based on two cases that were Argentina and Greece. This is not the way to think about policy. Policy should be done looking forward. If I can make the parallel with the Fed here in the US, don't repeat the mistake in Dodd-Frank of limiting the powers of the Fed in a systemic crisis. Don't fight the last political war. Look ahead and think about the future. So I think one homework that the fund could deal with is to define sustainability better. And I know it's not easy, but there is a concept out there called fiscal fatigue that some people at the fund has been working on, essentially to define what is the plausibility of the debt stabilizing primary balances that a country would have to adopt in order to achieve some level of sustainability. You can create a fund chart with these primary balances. You could have a table that every 6 months places each country of the world or each member country of the fund into each of the 3 buckets. And so markets would be able to define at every moment in time what that country is. And if you are willing to do that, then I think this policy could have a chance to work. Thank you.
Thank you, Angel. I'm going to open it up. We have some very knowledgeable and distinguished people in the audience for discussion. But first, let me give Sean, if in 3 minutes, any particular points raised you want to respond to, and then you'll get more opportunity later.
Thank you, Adam. First of all, I want to thank my panelists for having made it through the paper, in some cases 3 times, and for their constructive comments. I think at least I see the issues, there are 3 issues, at least the way I divided it. First of all, do you think that our lending should be premised on some assessment of sustainability as the overarching consideration? My sense is, even from Angel, that the answer is yes. That we don't want lending to be based on geopolitics or anything else. We should be looking at whether or not, in the final analysis, this debt can be repaid. So we have to do some sustainability analysis, and I think I would be the first to admit, and my colleagues here in the room, the economists who I work with at the fund, would also agree, we need more work. There's more work to be done on improving. I think a lot of progress has been made, both in terms of transparency, but clearly more work needs to be done. The second point is that, okay, if sustainability is going to be the thing that we look at, is it appropriate that we calibrate our response taking into account where on the spectrum the country is on the sustainability? That's all. If we actually think that they're very sustainable, we don't actually think a restructuring is needed. If we agree on that, all we are saying in this paper is that the 2002 framework needs a tweak. Because right now, unless you're sure that debt is sustainable, unless you're really sure, you have to do a debt operation that actually changes the fundamental debt dynamics and gets you there. We would like to introduce some flexibility so that in circumstances where it's not as clear, you can get time to give you more time. You can actually do an operation that's not definitive, but provide some insurance. It's an additional tool that we would have in those cases. Now, based on the discussions that we've had with market participants on this, I don't think that really there's any objection that we've seen to that. Now, we need to look at this to make sure that we're not confusing people, because we're focusing on outcomes, not on specific operations and not on vocabulary. We just want to increase flexibility so that our lending framework is mapped more closely to the reality of the spectrum of debt sustainability, rather than being binary. That's all. And the final point is, so the question is, do we want flexibility along that spectrum? We think it's a good idea. Our sense is that most market participants thinks it's a good idea, but clearly we need to convince people that we're simplifying things, not making it more complicated. The final, and by the way, it's all going to be case by case. This idea of case by case versus rules, we all know that any debt sustainability is going to be case by case. That's not the issue. The issue is, do we want a conceptual framework that informs how we resolve those cases?
Thank you, Sean. That was your final point, you said. Okay. So I'm going to open it up to the floor. As usual, we have a traveling mic from Jessica in the front. We have a standing mic in back. I will recognize you. Please identify yourself before asking what should purport to be a question. Jessica, if you could go there, but first the gentleman at the back mic.
Thank you. Irv Chapman from Bloomberg Radio. A question for Lord Turner. There you are in Frankfurt, where the German body politic is 180 degrees the other round from the Greek body politic. So are Germany and Greece on a permanent collision course? And this week in Brussels with Greece, what's happening? What should happen? And what do you think will happen when the finance ministers go home?
How lovely and on topic. If I could ask Adair and then Angel to just give a concise response to Irv.
Ideally, in economic terms, I think there should be some Greek restructuring. I don't think this debt will get repaid in the normal sense of the word repay. And I think if there isn't some significant degree of restructuring and reduction of the net present value, Greece will leave the euro. Now, that might be the optimal thing to do, and I think almost certainly that on the German side, there will be people who say, well, don't blink, that would be a better result. The only thing I'm absolutely certain of, I do not think that Greece is about to turn into a country which achieves, as the plan is meant to be, a 4% primary surplus in 2016 and runs that effectively, permanently ever thereafter. I just don't think that that is going to occur, and I don't think that that is an optimal a policy. So I think the issue is, if both sides don't blink, Greece will leave the euro. I've always thought the most likely result is, and it gets to this great reprofiling debate, changing the interest rate. One of these games where you increase the maturity, you reduce the interest rate. It's always interesting to work out, if you take that to its logical extreme, which is a perpetual non-repayable debt at 0% interest, it will always be sustainable, but you can still tell yourself that you haven't reduced the face value of the debt. Most of the calculations are you can take about 17% of Greek debt down by those sort of games in a defensible point of view, i.e. maturity extension, which is not absurd, a reduction of the interest rates to a set of other reference rates which are not bizarre comparators. I've always thought that's the most likely result, but at the moment I'm not sure.
Okay. Angel, briefly, then we've got Hung. The gentleman at the very back, if you'll go to the mic, I'll recognize you, and then Doug.
No, I don't really have much to add. I think that the key issue with Greece is to understand that way over 50% of its debt is official debt. And it's official debt with incredibly low maturities, low rates, and especially it will take many years until it has to start to be serviced. So that debt is junior to private debt. And so from the point of view of the sustainability of the private debt, I think Greece is in a decent position if they can continue to hold to sustainable policies. That's all. They don't need to run a 4% primary surplus for that.
Okay. Hung.
Thank you. My name is Hung Tran from the IAF, and thanks all the speakers for very succinct summary of their view. My question is to Sean. I think that you may have run out of time to say much more about the second phase. First phase, triggers, last phase, closing mechanism. So my question is about the second phase to allow you some time to say something about it. And specifically about the lending into arrear policy, the key requirement of interest to private sector creditors is the requirement that sovereign debtor has to engage in good faith negotiation with creditors when they apply. Do you foresee any change or dilution of that requirement in staff thinking, particularly in the upcoming paper?
Thanks, Hung. Yes, so I didn't have a chance to get to this final point process, and in part I didn't think it was a big loss because we haven't really started our work on this area, but let me just very briefly say what our intention is. When we conducted outreach with respect to the market on the last paper, and including the removal of systemic exemption, introducing flexibility, our sense from the market participants was that they had no difficulty with this idea of just basing our lending decisions on sustainability. Their biggest concern was the issue that you have raised, which is that once the restructuring process has started, they want to have some assurance that the way in which the debtor engages with the private creditors, but also the way in which the private creditors engage with official bilateral creditors, who may also be subject to restructuring, is considered to be a fair one. And I think that the way we hinted a little bit, Hong, in our last paper on how we're looking at this issue, which is we want to focus on outcomes and on broad principles. I don't think that there is a sense that staff is suggesting that there should be take it or leave it offers, that we want to get a high participation rate in any debt restructuring, and that requires essentially real and meaningful engagement with creditors. The question is the way in which this engagement takes place exclusively through a formal creditors committee? Or are there other mechanisms as well that satisfy that objective? So we're going to be discussing that issue in this paper, and we will want to have a discussion with market participants on their thinking so that we can reflect it in the paper that will be discussed by the board, probably in the fall of this year. So we will be moving on that issue, but also on issues on how to deal with official bilateral creditors, which is also a very pressing issue. Thank you.
Thank you. My eyes don't fail me. I believe Ian is at the back mic.
Ian Telly, Wall Street Journal.
Doug is next.
Okay. Please excuse my ignorance here. I'm not an economist. But viewing the Ukraine and Greek situations, it seems to me the credibility question is quite clear. I remember asking repeatedly whether Greece, IMF was going to request debt restructuring, and I was told repeatedly that no, it was never considered. We're not going to discuss it at all. And of course, there were suggestions early on. Ukraine, Anna pointed out that Ukraine's debt is sustainable to high level. And then, of course, in terms of the lending into arrears, of course, the IMF puts Naftogaz, which is 100% state-owned debt, to the side and doesn't include that as part of their lending into arrears strategy. So it seems to me that markets perceive the IMF debt framework as already uncredible. What's unclear to me is why it really matters. I understand markets want some clarity about the rules of the road, but it doesn't seem to be breaking any sort of efficient functioning of markets right now in the globe. Everybody seems to be buying everybody else's debt, right?
Another way of putting Angel's point earlier, I think. I'll let Sean respond, but I also then want to open it up to other members of the panel.
So briefly, I don't want to get into the Ukraine. I think that in terms of what happened with the fund and Greece in 2010, I think the paper is relatively straightforward, that we think that there should have been an earlier restructuring. And that's one of the reasons why we want to basically eliminate the systemic exemption, because that was the vehicle that we used to delay that process. My own view, and maybe this is overly formalistic, was that it would have been less credible for us to have just said, well, we think debt is sustainable with high probability, when we clearly didn't think it was, which is why we said we're not going to say that because we can't, so we amended the rules. We were transparent, and we think that, at the end of the day, you may think that that was also a mistake of introducing the systemic exemption, and we agree with you in retrospect, but we wanted to basically preserve some integrity on the sustainability analysis by lowering the standard, which is what we did.
Anna or anyone else? Yeah, Angel.
Very quickly. So why is Ukraine not relevant? Because there are no other Ukraines, right? That's what I meant to say by the power of anchoring. The problem with rules that are defined too rigidly and don't take it the negative way is that there could be one day in which that rule is applied in a new situation, and then it generates the domino effect. That's why the PSI anchor was so important, because all of a sudden, when you realize in 2010 or 11 that the condition for any program is to restructure your debt, then you apply that framework to everybody else. You could say the same thing in 97, 98, the first peg breaks and then everybody goes after the next ones. That's what I'm trying to say. So in this case, it's sort of irrelevant. This Ukraine is a very specific sense. It's a very specific case. But you don't know what the future is going to look like. And I think that's where the anchoring problem is there.
Anna?
Right, so just following up on that, and I actually agree with Angel in substance that Ukraine is unique. The problem is, so is Argentina, so is Grenada, so is Greece, so is Belize, so is, in a world of a couple of dozen issuers with steady market access, everybody is special, right? There are thousands of companies listed on the New York Stock Exchange. That's when you can talk about a sample. Right? So therefore, going back to Ian's question, what is a credible rule in this space? Right? What is a credible commitment by an organization that by definition, just by its mandate, is pulled into different directions? And I would submit that it is not a detailed, arcane, process-sensitive rule. So if I'm in the market, and I'm very not, I would be really careful about hoping for the IMF to to sort of run my restructuring process and to be the pressure point for the debtor to talk nicely to me. Because I am one of many constituents on the fund, and the fund has no capacity to compel the debtor to come to the table, right? Therefore, I'd say fewer rules, but more disclosure, more reasoned justification, so that a pattern can be deduced and reasonable judgments can be made.
Thank you. Unless Adair wants to come in on this issue. I didn't think so. Thank you. Doug.
Thank you. Three comments, three suggestions, primarily to Sean, because you're the representative of the fund, but obviously for everybody. The first one is on, and I think Angel did a great job of defining this in his statement, how you define sustainability. The fund, I think, put out a paper in August 2011, if I recall, which basically said sustainability is subject to a lot of discretion depending on the circumstances. And I guess the suggestion would be, Adair mentioned if you had a zero coupon perpetual for Greece, the country would be sustainable. And I guess my question is that true under the fund's policy of seeking 120% of debt to GDP? Because actually the total amount of debt outstanding would not decline. And so actually, even under a zero coupon perpetual scenario, if you don't do something to the definition of sustainability, you're still not sustainable under that metric. So question number one, or comment number one, is go back to the August 21, 2011 paper. The definition of sustainability seems to me to be the key point here. Everything else on the left side of the equal sign has to actually reconcile with the right side and the discretion. The second point is on the systemic exemption. And I've raised this with you, Sean, in the past, but it does seem contextually about making each country unique. The question I have is, under the fund's articles, which require you to do what's right for each individual country, how do you reconcile that when a country is part of a monetary union? Because that is why Greece ended up triggering the risks of contagion. It wasn't the unique nature of Greece, it was the unique nature of a monetary union. So I'd encourage work being done on reconciling the articles requiring you to do a country-by-country analysis and countries that are in a monetary union. And the third is on transparency, where the fund did a great job about a year or two ago of coming up with the template and the heat map, which were made publicly available so that the market could make its own assessment of sustainability. However, in actually trying to use that template, what I have found, and others I know as well, is it's virtually impossible to do so. So it's out there, but it's actually not usable. So a question, how do you make it easier to access? And could you have the fund actually input the assumptions they make so that markets can easily toggle around with their assumptions and then make the heat map and the template more usable for the markets to make their own independent assessment?
I'll ask my colleagues to, with no disrespect to Doug, to skip over sort of the software upgrades on interfaces. That's not our thing. But on the other two issues, I'd welcome anyone's comments. Obviously, Sean wants to speak, but is there anyone else before? Yes, Adair, please.
I just want to make one comment provoked by what you said about the appropriate role of the IMF with a country within a monetary union. And I want to make the argument that in an ideal world, the IMF should have had nothing to do with the Greek problems whatsoever. That if you accept that the Eurozone is essentially a system which makes the individual nation states like state of California or state of Illinois, I mean, the IMF would never get involved in the debt sustainability of Detroit or Illinois or San Francisco. It is a dysfunctional system because it's as if the European Union, Eurozone is as if, in US terms, there were no federal debt. All the debt is at level of state of California, state of Illinois, state of New York, and is equal to 100% more of their GDP, with the banks which happen to be located in Illinois or California holding as their liquid asset reserves undiversified portfolios of the debt issued by that state, which could not be worse in terms of wrong-way risk, correlated risk. And it has to change radically. And by the IMF, was normal rules of the game, getting involved in Greece, it was one of the things that stopped the radicalism of the change that was required. It would have been much better at some sense if the IMF had said, now that you've had a monetary union, that's your problem, because that, I think, would have forced the Eurozone to grow up and face the really radical changes which are required to make it a successful monetary union.
Fiscal transfers good. Debt bad, fiscal transfers good. Sean.
Yeah, I mean, just Doug, on your question, first of all, on debt, the debt to GDP ratio is not the only dimension to the debt sustainability analysis. And even on that dimensions, 120% is not a magic number. But Reza, who's sitting right behind you, is the person who basically runs the DSA analysis. So you should make suggestions to him as to how it can be more accessible. On the issue of, basically to what extent can we essentially provide assistance to a country in a monetary union? Well, I mean, in some respects, this is less different than you think. You do have countries that still have balance of payments problems. One of the issues that came to the fore in the Eurozone crisis was the current account deficits that were being run by these countries, the lack of competitiveness. And I think that, and this is something that will be brought out in the paper that will be discussed shortly, is that even with integrated financial markets, the premise that you actually are doing the Eurozone a favor by delaying the restructuring of the sovereign debt is questioned.
Yep.
That's the point. We don't concede that in in a highly integrated market, delaying a structuring that needs to take place is actually good for that Eurozone. We actually, I think the paper you will see takes issue with that premise.
It very clearly does. And again, I'm worried I'm being too facetious. I happen to agree with Adair on fiscal transfers as well. I think those are very important points. Unless Angel or Anna wants to come in, last question of this session will go to Ted Truman.
Ted Truman here at the Peterson Institute. So I have a question that I guess to some extent bridges the two halves of this discussion. So on debt, right? So both Adair and Sean said capacity to repay the debt. So who says that debt has to be repaid? Why is that the test? Yeah. Right? I mean, I remember I was, I'm wishy-washy. I studied under Tobin. And he wrote on this great, what was it called, a committee on whatever it was called in the 1960s, right? And he said, government debt plays a role, just like money does, right? And we don't know what the optimal level of government debt or even private debt is. And the notion that you have to repay it because in some sense, that's necessary before you appear before the pearly gates strikes me as nuts, right? So you really have to say, you can say that the level of servicing, right, is a burden, right, and therefore you should get the stock down. That I can understand. But the notion, the test of repaying, and actually you have to, I think, go an extra step in order to do that. And both Sean, who may have misspoken, and Adair, who probably didn't, used the test of repaying the debt. Why?
That is a very good note to end on. Sean, Adair, and any others?
Yeah, I mean, back in the early 1980s, the fund came up with a series of papers at the beginning of the Latin American debt crisis. And the premise of those papers, which I don't think has changed, is that when countries can repay their debts, they should. And that essentially the fund's policy should be supportive of that because the fund's role is to essentially promote not only market economy, but medium-term sustainability. And medium-term sustainability for most countries is returning to the market. And if you don't repay your debt, your capacity to return to the market is going to be more limited. So we're talking about the exception to that general rule. And the question is, what is the basis for that exception? And our view is that the basis for that exception should be capacity. Now, we accept, just as it is in the corporate context, but we accept in the sovereign context, making judgments about capacity is a lot more complicated because of the fact that the assets are theoretically inexhaustible because of your taxing power, but you need to make a judgment as to what point that taxing power becomes counterproductive.
Thank you. Adair?
I think there is, again, a crucial distinction, the one that I made, between debt which is issued by somebody who is also a currency issuing power and not. I think where you have debt issued by somebody who is not a currency issuing power and cannot monetize it, of course there is no necessity to pay down the debt to zero. There's nothing about the debts that need to be paid down to zero, and I don't think anybody ever runs those scenarios. But there is a need, or there can be a need, to have the debt at a sufficiently low level relative to GDP that people believe that the debt servicing on that can be maintained and it will not relentlessly increase. Because if you don't do that, at somebody's stage, the market will respond and say, I don't believe you're going to repay me ever, therefore I'm going to charge you a high interest rate on your next bit of debt. I think it is very different for a country which is a currency issuing power. And I used the reference to Japan and said this will eventually be permanently monetized. Of course, the alternative is that it's just permanently rolled over. I mean, as long as the market is willing to accept that every year the Japanese debt to GDP ratio goes from 230 to 240, and then maybe in 50 years' time it's 500 to 560, at one level, well, why not? But what Jon's dealing with there is a limit case where if people literally just accept that as a pure token without expecting it to be repaid, debt has effectively become money. and it's just a financial asset, created by the government. And of course, there is also the interesting limit case there that the longer the maturity and the lower the interest rate, the closer debt is to money. I mean, money is just perpetual debt with a zero interest rate. So I think there are some limit cases in there, and the issue of debt sustainability for a country which is also a currency issuing power is much less clear as a concept than for ones which are issuing not in their own currency, which also includes, therefore, now the countries of the Eurozone.
Thank you all very much. I think this has been a superb discussion. In particular, gratitude to Sean for engaging so substantively and frankly, but Anna, Angel, Adair, all part of the A-team, did a brilliant job. We're going to turn to private sector debt, as Adair initially mentioned, and we all recognize the accumulation of private sector debt in some sense preceded and is the other side of the coin to much of the recent public accumulation. And in particular, we're going to have Susan Lund presenting the McKinsey Global Institute's estimates on the stock, the current stock of private sector debt, household and corporate around the world. I think this is going to be a very equally important and rewarding discussion. Just two last points. First, on Japan, I would urge, as much as in theory Adair is right that a zero interest government guaranteed thing looks like cash, you have to be a little careful when you start saying the market. The market in Japan that determines that there's an infinite appetite for that debt looks a little different in terms of its legal structure and who's participating than the market for Greece. And it's not just as a cautionary note that we can't all easily become Japan, nor would we want to. Second, most importantly, I now have the pleasure to invite all our guests who are here, unfortunately not our guests on the internet, to join us for lunch. We will reconvene promptly at 12:30 with Susan Lund's remarks. Thank you all very much.